Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name is Patrick Dunawella and I'll be your host. We've got a great show for you today. JC Parets is returning to the show. If you don't know JC, he's the founder of All Star Charts and he's probably the most outspoken technician I know. I'm really excited to hear what he has to say about the current market environment, but before we talk to JC, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed higher on the week. The NASDAQ led, gaining 2%. The Dow lagged, but it still inched up about 0.25%. Now, one of the biggest developments this week was the fact that the S&P 500 reclaimed its 200-day moving average for the first time since April. Now, we're still battling with that downtrend line that's been in place all year, so we'll see if the bulls can finally break through that next week. Taking a quick look at the sector performance, 9 of the 11 sectors closed higher. Communications have been the laggard all year, but they actually led this week, gaining about 3.5%. Energy has been the leader all year, but it actually lagged this week, dropping a little more than 1.5%. So things were a little backwards as far as sectors go. Anyways, that's enough from me. Let's welcome JC back onto the show. All right, JC, welcome back to the show, and thank you for joining us today.
Happy to be here. What's up? What are we talking about today?
Well, first and foremost, let me congratulate you on the twins. I can't imagine how busy your household must be right now.
Gets a little crazy, that's for sure. 2-year-old girl and newborn twin boys. Yeah, it's a lot. So just enjoy your peace and quiet while you have it, because
Yeah,
none of that going on in my house.
yeah, it's gonna be a while for me. But let's get right into it. So we're recording this on Thursday, December 1st, and of course we just got a fresh batch of monthly candlesticks. So I gotta ask you, is there any monthly candles that really stood out to you?
You know, dollar yen is one. For sure, we got back to those former highs and just totally rolled over hard. Ripper and yen, that one definitely stood out. And I would say the chart of financials and home builders overlaid with one another, going back to pre-Great Financial Crisis. You know, obviously, I mean, maybe not obvious to a lot of people. I don't hear anybody talking about it actually, but for me, it seems obvious that the high in financials before the Great Financial Crisis is arguably one of the most important price points in American history, world history even. Literally, think about it. The peak in financials before the Great Financial Crisis. Yeah, how could that not be important? This is the '07 highs in financials. Well, guess what? Over the last few months, we've successfully tested those levels. After breaking out after 14 years, we were back down to the scene of the crime. Nobody was talking about that, successfully retested it. And at the same time, you had the highs in home construction stocks from the '06-'07 highs. Again, before the real estate bubble collapsed, subprime, that whole thing. I would put that right in there with the financials, one of the most key price points, again, in American history. I'll say it again. So when you put them both together right at the same levels, retesting at the same time successfully, that one definitely stood out. So those are the two for me.
Yeah, I mean, financials, they were skating on thin ice there for a second, but as you said, I mean, they successfully retested it, right? But maybe that was back in October, but it was been a really
process. Listen, it's been a 4 or 5 month process. Started in June. Has been June, July, August, September, October. It's been a 5-6 month process of retesting those former resistance levels, which further reiterates just how important it is. The market is literally showing us the supply and demand dynamics, the way that they're behaving, reiterates what I had originally thought was going to be an important retest, whether successful or otherwise. And the fact that it's taken this long, or took this long, if you will, I think just reiterates that it was important.
That's interesting, though, that the financials were the ones that really stood out to you. I mean, I think maybe you told me this, or I don't know where I heard it, but you hear you can't have a bull market without the financials participating, right? Or at least they can't be going down, right?
Right. Yeah. I mean, they don't need to be the leaders. You know, we've had growth leadership and other stuff leading in the past in bull markets, but you can't have financials crashing, at least not, you know, in America and most countries, really. You know, a lot of financial exposure out there. You know, you don't really have bull markets with financials crashing. You know, when things when markets are in trouble, usually financials are one of the culprits. And we've been seeing the opposite. We've been seeing relative strength out of financials.
Although Credit Suisse, that still looks terrible.
Yeah,
I don't know if that'll ever change.
One really sucks. You know, one couldn't look worse, right? It's like if they got involved in crypto and we don't know it yet or something, you know, who knows?
Yeah, I think
none of the other European banks are doing that. Deutsche Bank's not doing that. European banks in general aren't doing that. European banks are leading. Indian banks are leading. Like, so it looks like a one-off to me.
And we'll get into India and all that too. But I want to dig a little deeper into the broader market here. And we kind of have a bifurcated market, right, at the index level. The Dow only needs like 6% to return to an all-time high, whereas the NASDAQ needs like 40%, right? And of course, tech is pretty much the culprit for that. The NASDAQ is very tech heavy. So let me ask you this. Which sectors have your eye right now? Which sectors do you like and which sectors do you want to avoid?
You know, I mean, for me, I like to stick with leadership. You know, why get cute and like pretend that tech is still an outperformer or communications are still outperformers? That was years ago, right? And they were outperformers for a long time. They were outperforming for a decade in a falling rate environment, which is perfectly normal for growth stocks to be the outperformers in an environment where rates are falling. However, some people clearly didn't get the memo. Rates haven't been falling for a while. They've been going up. And what are the types of sectors that tend to do well when rates are going up? You know, more cyclicals, industrials, materials, financials. Those are you know, certain healthcare names. Those are the types of stocks that should be outperforming. And as it turns out, those are the stocks that are outperforming. At first, it was just energy. Then it was energy and healthcare. Now it's energy, healthcare, industrials, materials, financials. Now staples are added to the list. You're getting more and more outperformance. So to make a bet that all of a sudden growth is going to start to outperform, you know, it's not a bet that we want to make. Are you going to see periods of time where you do see growth outperforming a specific day? I mean, today's Thursday, December the 1st. Yesterday, for example, growth stocks did outperform, right? Bonds ripped, rates got slammed, and you had a day. But from a secular standpoint, even from a cyclicality standpoint, over the quarters and years, should we expect technology to be an outperformer? I see no evidence of that being the case at all. Quite the opposite. I think that the unwind out of technology and growth on a relative basis continues to persist for some time. We're talking about half the NASDAQ is technology. A quarter of the S&P 500 is technology. And by the way, a quarter of the S&P 500 is technology. That doesn't even include Amazon, which is a consumer discretionary stock, Tesla, right. No Tesla, Facebook, Google. None of those stocks are technology stocks. So it's 25% plus all those others. Now you're talking about half the S&P 500 is essentially technology. So it's not the other stocks' fault that the S&P 500 has way too much tech exposure. Meanwhile, 5% of the S&P 500 is energy, up from 2% a couple of years ago. Materials still represent less than 3% of the S&P 500. So that unwind, that alligator's mouth closing, I think continues. And, you know, we've been talking about how it's a trade of a generation, sort of that, you know, long energy, short technology. And that's really been working very, very well.
Yeah, you know, I had Walter Deemer on the show a couple weeks ago or a few weeks back, and he said something that really, really stuck with me, which is new bull markets tend to feature new leaders, right? And that's really on your point there. You know, should we expect technology to lead us out of this bull market? Maybe not. But it sounds like you're still pretty bullish value. Is that fair to say?
Yeah, I mean, listen, I think the major indexes continue to go higher. They're just going to underperform some of the outperforming areas, right? I guess by definition, but more so, you'll see the dispersion continue to be very wide, in my opinion. You know, reminds me of early in my career. You know, we were coming off the lows after that tech bubble. I started in the summer of 2003, literally the beginning of that bull market. And we were coming off, a historic crash in tech and growth. And early in my career, we weren't buying tech stocks. We were buying energy and industrials and financials. Like those were the types of whole stocks, those are the types of names that were doing very, very well. And guess what? Interest rates were rising back then too. So this reminds me a lot of that period. And, a lot of investors, number one, weren't around for that period. Number two, those who were love to forget, right? Most people don't even care, don't even bother to look and just analyze those correlations. So it reminds me a lot of that.
Well, so sticking with the leaders here, one topic that's been getting a lot of coverage the past week or so has been this growing divergence between crude oil and energy stocks, right? I mean, energy stocks are up like 70% year to date. Crude oil has pretty much given up all of its year to date gain. And they were moving together for the first half of the year, but then around the summertime, they kind of just started parting ways. So what do you think of that here? The big question here is, are energy stocks going to catch down to crude oil, or is crude oil going to catch up to energy stocks, or do they meet halfway? What do you think of all that?
I mean, for me, I continue to be very, very impressed with the resiliency in energy stocks despite the selling in crude oil futures. Like, to me, that relative strength is very impressive. Also, we know from experience that energy's bull markets and energy's outperformance historically doesn't last quarters or years. It lasts a decade, right? And we're a couple of years in, so we're still in the early stages. So when you look bigger picture, you zoom out, we really want to be betting against energy stocks? Not for me. I want to be buying breakouts. The XLE, the energy index, just closed at a new all-time high, all-time monthly closing high. So did Exxon. So did Chevron, by the way. Look at oil services now trying to participate as well, going out a new multi-year high. So I would be, I wouldn't be I wouldn't be shorting energy from any sort of intermediate term perspective. If you think it's a little overdone, you're looking for a pullback, you're looking for a little scalp, a little trade, knock yourself out. But bigger picture, I think we want to be net buyers of energy. I don't like shorting oil, that's for sure. I like sleeping at night. And, if oil is above 76, that puts us above a lot of former resistance. That's key support. We've bounced off those levels in the past. If we're above 76, I think you could be long oil, certainly not short. But I continue to like the energy stocks over the commodity. And by the way, we're seeing that in a lot of other areas too, where the stocks are doing better than the commodities. Right?
Like
You're seeing that in precious metals, for example.
Oh,
You're seeing that in base metals. So the stocks over rocks, if you will.
I like that. And I also liked what you had mentioned a little bit before, where you pointed out, energy is still just 5% of the S&P 500, and that's up from 2%. And I mean, one stock, Apple, right? That's, I think, 6 or 7% of the S&P 500. Someone's got to double check my math there, but I mean, you kidding me? Like, that one stock is bigger than the entire energy sector still, right? And materials, right? And so
Apple's 6%, and energy's only 5.3%. Materials are 2.3%. So you're looking at energy and materials put together at 7.5%. Apple's 6%. Between Apple and Microsoft, you're looking at 11% of the S&P 500, just those two stocks alone. So when you look at materials, energy, they're irrelevant. These sector indexes could triple. It's not going to make a dent in the S&P.
You looking at Koyfin there?
Am I looking at Koyfin charts?
Yeah.
To get the weightings? Yeah, I look at Koyfin quite often to do that.
Where else would you go?
My hacks.
Yeah.
Koyfin's a good tool.
Well, so on that topic, though, what do you think of Apple? Because that was another one this week. A lot of people are looking at Apple, and it does look pretty toppy there. So is that something of concern to you? Because like we just said, it is the biggest stock out there.
Yeah, I do the analysis in reverse here in this case. The weight of the evidence continues to suggest that the path of least resistance in equities is higher. I don't know what everybody's so angry about. Stocks stopped going down in June. We're now in December. That was 6 months ago. Stocks stopped going down. I don't know what this bear market that everybody's talking about. I don't see it in price, which at the end of the day is the only thing that's going to pay us. People are like, oh, JC, but the fundamentals. Yeah, maybe your interpretation of the fundamentals suggests stocks should go lower, but nobody cares about your interpretation of fundamentals. We only care about the market's interpretation. That's the only interpretation that pays anybody. So if the weight of the evidence suggests that the market's going to go higher, then I can't imagine the largest component of all of those indexes, the world's biggest company, is going to be crashing in an environment that the overall market's heading higher, particularly 6% of the entire S&P 500. So when you do the reverse math, are you going to bet against Apple if you think the stock market in general is going to go up? That's not a bet that I'm going to make, especially if we're above 140. If we're above 140, I don't see any issues with Apple whatsoever. It doesn't necessarily mean you want to be long, because you'll probably underperform as technology tends to do in these sorts of environments. But I definitely don't want to be short. It's really in the middle of a bigger range. I'd leave it alone. If we start to take out the summer lows and Apple or something like that, you really want to short it, knock yourself out. But we're not down there, so that's not something that I'm doing right now. Is worrying too much about Apple.
Yeah, so one big part of your thesis this year has been the dollar, right? And you've been very vocal about the fact that it's really been all about the dollar, driving a lot of the trends across the markets. And guess what? We finally broke below the 200-day moving average on the dollar today. So was that it for the dollar, or do you think we just go and retest that base?
I mean, here we are in December. British pounds bottomed on September the 26th. Euro bottomed 2 days later. That alone is 70% of the dollar index, just those two alone. When you broaden it out and you look at emerging market currencies continuing to make new highs, over the last 6 years or so, when the dollar is weak, stocks are strong, right? Stocks are strong. And when the dollar is bid, stocks are under pressure. And it really comes down to the fact that the US dollar has been the only safe haven. My entire career, when stocks would be under pressure, you get a bid in bonds, you get a bid in Japanese yen, even gold to a certain extent. And, this year, what'd you get? You got bonds doing worse than stocks. You got yen making new 20-year lows, gold useless, right? None of those things worked as any kind of safe havens. Gold's not a hedge against inflation, perhaps a hedge against profitability, but certainly not inflation. The only true safe haven, and again, not my opinion, because I don't give a shit. The only safe haven using basic arithmetic has been the US dollar, right? The correlation has been very, very strong negatively. Equities peaked, the New York Stock Exchange new highs list, for example, peaked in May of 2021. Guess when the dollar bottomed? May of 2021. That's not a coincidence, right? And sure enough, the dollar's been under pressure, as you mentioned before. Emerging market currencies are ripping. British pounds ripping. Euro, the whole thing, even yen is ripping. All these currencies are doing great against the US dollar. How have stocks done in that environment, my friend? The Dow Jones Industrial Average is up 20% off the lows. So now these idiots could write their stupid articles about how now we're in a bull market or whatever. Stocks bottomed 6 months ago. I don't know what everybody's so angry about.
Well, so let me ask you this. Why are you looking at emerging market currencies? And also, could you tell us what's in, what is this, an ETF, this CEW?
Yeah, so CEW is the Wisdom Tree ETF, and it's an emerging markets ETF. I'll get you the exact. I know Brazilian reals up there, rupee. But what you're going to get is you're going to get a real... you're going to get a real, sort of a higher beta, further out on the curve look at the US dollar. While you might look at CAD and Aussie, maybe more commodity focused, Euro's a big component, and British pounds and yen and all these things, emerging market currencies are really way out there on that risk curve. So, in Latin America, you're looking at Brazilian real, of course, Chilean peso, Colombia and Mexican peso. When you look specifically at the Mexican peso versus the United States dollar, it's typically quoted in dollar peso. The dollar peso and the volatility index trades tick for tick together. So when the dollar peso is under pressure, in other words, the Mexican peso is doing well, that means volatility is falling When the volatility index is falling, how are stocks normally doing in that environment? Stocks historically are doing well with declining volatility. So, even when you look at a dollar peso spread, I mean, that in and of it, that alone is giving you a lot of information in equities. In Europe, of course, you got Poland, Russian ruble, South African rand, Turkish lira. And then in Asia, of course, you got the yuan, rupee. You've got, the Taiwanese dollar, Philippines. You got the Korean won, Thai baht, right? So those are the types of currencies that are in there. And, I think it really tells you a lot about the dollar without making it a euro story, right? People are like, oh, the dollar's just the euro. It's like, well, the dollar index is a lot of euro, but there's a lot of countries out there, guys.
Well, so that's kind of why I asked, because, obviously the euro is a large part of the dollar index. But I like what you said there about how these emerging market currencies are kind of more higher beta and therefore might give you maybe an earlier tell, right?
In this case, later, right? It's also like sometimes earlier, sometimes not, right? It really just depends on the environment. Like, the emerging market currencies were a little later to the party. The British pounds were the first ones to bottom out.
Well, so speaking of the globe here, another big theme that I've been hearing a lot lately has been the strength outside of the U.S., right? And that's kind of new, right? The U.S. has kind of been the place to be, but if you look at something like, VEU, right, which is the Vanguard ex-U.S. all-world ETF, it's outperforming the S&P 500 by a decent margin over the past month or so. So what do you make of that? And are there any countries in particular that you like right now?
Well, India just closed at new all-time highs, all-time monthly closing highs on the Nifty 50.
How about that base, right?
Nifty 50 and Nifty 500, both of them. Look at Indonesia as well, continuing to act strong. Look at London. Look at the London FTSE 100 and look at the London FTSE 350, which is broader. You know how much exposure the London FTSE index has to technology? 0.0, Mr. Blutarski. 0.0. Hence why it's so close to making a new all-time highs. Granted, it didn't have the run-up over the last couple of decades that the United States had with all that tech exposure and some of these other countries as well. So basically, London's done nothing since I was in high school, which is crazy. At least the FTSE 100, the 350's made a new high, but the FTSE 100 hasn't done anything. And a lot of that is its lack of tech exposure. But when tech is out of favor, as it's been, you're going to see outperformance out of the countries that don't have any tech exposure. And FTSE 100 and 300 have none whatsoever, zero. And you're seeing that. So those are a few that stand out. Another thing that I would like to point out is the strength that we've been seeing in emerging market stocks priced in local currency, right? So the strength in the United States dollar has made dollar-denominated country indexes and ETFs underperform and look weaker because of the stronger denominator. However, when you look at them in local currencies, half the emerging market countries are above their 200-day moving average, like almost 60% at this point. And when you look at them priced in US dollars, it's a fraction of that. So I think if you get that dollar weakness, I think you're really going to get that ripper out of emerging market stocks. You're seeing it in China. You're seeing Chinese internet, Chinese technology, Chinese stocks in general doing very, very well.
Yeah, I think I saw
me as a risk-off scenario.
I think I saw it was the best month for the Hang Seng since 1998. I want to say. Double check me on that, but whoa. And I like that you brought that thing up about the priced in local currency versus the dollar, because you look at India, for example, right? Beautiful one-year base breaking out, but that's priced in rupees, right? And you look at it priced in dollars, it looks a little different. So, it really all comes back to that catalyst, as you said. It's a really kind of
DXJ, for example. DXJ is the Nikkei priced in yen.
Okay.
And it's making all-time highs, right? You want to talk about countries that, indexes that stand out. Yeah. Japan in yen making new all-time highs. Listen, local currency or otherwise, how many countries do you know making new all-time highs?
Right. Not many. Not the U.S., certainly. Although Dow is only 5
By the way, the
5,
Dow's only
6% away.
5%. The Dow's only 5% from a new all-time high for those
Wow.
keeping track at home.
Can you believe that? All the craziness this year. And repeat what you just said. The Dow is what?
Yeah, the Dow's 5%. Coming into today, the Dow was 5% from a new all-time weekly closing high. 5%.
Oh man, never a dull moment. But let's finish up with crypto. There's so much about it in the news, almost to an exhausting level. Not even almost, it's exhausting. But structurally, from the chart, there's really not much to love, right? We're below those prior cycle highs. But I want to talk about crypto sentiment, right? Because sentiment, I don't know if I've ever seen crypto sentiment this bad, JC. But is it too cute, do you think, to be using sentiment to gauge Bitcoin here?
No, but I wouldn't really read too much into it because we know sentiment's down in the dumps. There's all these frauds and these things are down. A lot of these altcoins are down 90% or a lot more than that in some cases. So like the fact that we're seeing like these magazine covers and like all these like, polls talking about everyone's bearish. It's like, yeah, that sounds about right. Right. So I don't think it's like that much of a shocker to see that sort of thing. Are we near washout levels? Are we near sentiment levels where we tend to get strength from an asset? I think so. I think stocks were here in this sort of environment this summer. And we've seen how well stocks have done. The Dow Jones Industrial is already up 20% off its lows, more so. I think crypto is something similar. But of course, we don't get paid on sentiment. We get paid on price. So I think you mentioned it before. The prior cycles highs, I'm looking at Ethereum right around 1,400. I'm looking at Bitcoin right around 19,000, 20,000. Those are the late 2017, early 2018 highs. If we're above those levels, we want to be long those. And Ethereum's getting close. Ethereum did not make a new low. As Bitcoin broke the summer lows, Ethereum did not. So that sort of relative strength piques my interest. And if we're above 1,400, I'm in.
Straza always gives me a tough time because I tend to bet on failed breakouts or failed breakdowns before they kind of materialize. But man, could you imagine if Bitcoin does reclaim 19,000? That's going to catch a lot of people off guard. What do you think?
Yeah, and I think that's exactly what happens, and we rip to 30.
Well, awesome. JC, we got to wrap it up, but thank you so much for coming on, and we'll be sure to talk again soon.
All right, Pat. Adios.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.